Welcome to the second video for this week. In this video, I will cover borrowing costs IAS 23, government grant IAS 20, and investment properties IAS 40. The learning outcomes are focused on the three areas to be covered in this video, which are borrowing costs IAS 23, government grants IAS 20, and investment properties. Borrowing costs IAS 23. An entity may incur significant interest costs if it has to raise a loan to finance the purchase or construction of an asset. IAS 23 defines borrowing costs as interest and other costs that an entity incurs in connection with the borrowing of funds. Borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset must be capitalized as part of the cost of that asset. So in other words, borrowing costs may relate to qualifying assets or to other assets. If they relate to qualifying assets, then they will form part of the cost of the asset. Otherwise, they'll be expensed in the normal way. So the standard states that other borrowing costs are recognized as an expense in the period in which they are incurred. What are qualifying assets? Qualifying assets are assets that take a substantial period of time to get ready for use or sale. So the capitalization should begin when expenditure is being incurred on the asset, borrowing costs are being incurred, and activities are in progress that are necessary so as to prepare the asset for its intended use or sale. Capitalization ends when substantially all of the activities necessary to prepare the asset for its intended use or sale are complete. So in essence, qualifying assets depends on whether the borrowing is specifically for the cost or construction of the asset. So specific borrowing costs to be capitalized. According to this standard, the borrowing cost to be capitalized in respect of a specific asset will be the cost less any interest income received. General borrowing costs to be capitalized, that would be a percentage, which is the capitalization rate, multiplied by the expenditure incurred. That is it for borrowing costs. Simply, if the costs relate specifically to the construction of an asset or the purchase of an asset, it becomes directly attributable cost and therefore must be included as part of the cost. The second topic for this video is government grants, IAS 20. In many countries, the government provides financial assistance to industry. The most common form of such assistance is a government grant of cash. So it's a grant of cash from local or national government. Such grants are defined in IAS 20 as government grants. So they could be grants related to assets or grants related to income. Grants related to assets are for the purchase or construction of long-term assets, in other words, non-current assets. Conditions may be attached to a grant, specifying the type of assets that should be purchased with the grant, or the location of the assets, or perhaps the period in which they are to be acquired or held. Grants relating to income are any other government grants. Accounting for government grants. IAS 20 states that government grants should not be recognized until there is reasonable assurance that 1. The entity will comply with any conditions attaching to the grant, and 2. The grant will be received. Once those recognition criteria are met, the grants should be recognized in profit or loss over the periods necessary to match them with their related costs. Neither type of grant should be credited directly to shareholders' interest in the statement of financial position. They must be reported on a systematic basis through the income statement or through profit or loss account. Let's now focus on grants related to revenue. For grants related to income. For grants related to income, IAS 20 states that an income approach should be used, and the grant should be taken to income over the periods necessary to match the grant with the cost that the grant is intended to compensate. IAS 20 allows two methods of doing this. Method 1. Include the grant for the period as other income for inclusion on profit or loss for the period. Or method 2. Deduct the grant for the period from the related expenses. Example. Suppose that a company receives a cash grant of $30,000 in January year 1. The grant is towards the cost of training young apprentices, and the training program is expected to last for 18 months from January year 1. Actual costs of the training were $50,000 in year 1 and $25,000 in year 2. Solution. The grant should be recognized partly in profit for year 1, $20,000, which is 12 months out of 18 months, multiply that by 30,000, and in partly year 2, the remaining 10,000. The grant should be taken to income either by recording the grant as an income, 20,000 in year 1 and 10,000 in year 2, or deducting 20,000 from the training costs in year 1 and 10,000 from the training costs in year 2. At the end of year 1, there is a liability of 10,000 in the statement of financial position for the grant received but not yet recognized in income. Grants related to assets. For grants related to assets, IAS 20 allows two methods. The first method is to deduct the grant from the cost of the related asset. The asset is included in the statement of financial position at cost less the grant amount deducted. The depreciation is then charged on the net amount over the useful life of the asset. Method 2. Treat the grant as deferred income and recognize it as income on a systematic basis over the useful life of the asset. Basically, the method that you use to depreciate that asset, you use the same method to release the grant. Example. Suppose that a company receives a grant of $400,000 from the government towards the cost of an asset that costs $1 million and which has an estimated useful life of 10 years and no residual value. One way of accounting for the grant would be to record the asset at cost, net of grant, $600,000, and then depreciate the $600,000 over 10 years. which is 60,000 depreciation charge per year. The other method is to record the asset at cost 1 million and depreciate 1 million over 10 years, which is 100,000. And also to account for the grant as deferred income, a liability in the statement of financial position, and release the grant as income over the next 10 years, possibly at the rate of 40,000 per year. So 100,000 less the 40,000 released is a net charge to profit and loss account of 60,000, just as in the previous example. These two methods, therefore, achieve the same effective result, but different presentations in the statement of financial position. Disclosure requirements. IAS 20 requires the following disclosures in the notes to the financial statements. The accounting policy adopted for government grants, including the methods of presentation in the financial statements. The entity must also disclose the nature and extent of government grants recognized in the financial statements and an indication of other forms of government assistance from which the entity has directly benefited. And finally, unfulfilled conditions and other contingencies attaching to government assistance if this assistance has been recognized in the financial statements. Now finally, let us look at the final topic, which is on investment property, IAS 40. An investment property is property which is either land or buildings, which is held to earn rentals or for capital appreciation or both, rather than A, for use in the production or supply of goods or services, for administrative purposes, or for sale in the ordinary course of business. So in essence, an investment property is not used as we had it under IAS 16. The purpose of holding the property is to receive rentals, to earn rental income, or for capital appreciation. How do we account and measure investment property? Initially, investment property is recorded at cost, just like property, plant, and equipment. Subsequently, investment property may be measured either using the cost model or the fair value model. The cost model is the same as the one we looked at under IAS 16, where the property is carried at cost, less any accumulated depreciation and less any accumulated impairment losses. The fair value model, on the other hand, is where the property is carried at fair value. So at each year, the property is carried at fair value, with gains or losses on adjusting fair value recognized in the calculation of profit or loss. So if there is a gain, the gain goes straight to profit or loss. If there is a loss, it goes straight to profit or loss. Unlike the revaluation model under IAS 16, the gain never goes to other comprehensive income. So in this instance, annually, the property is stated at fair value, with changes in fair value simply taken to profit or loss, whether it be a gain or a loss. This now concludes the second video for this week. I hope you've benefited from it. Please go onto the ALA page and answer the questions together with the seminar questions presented. Remember to enclose your answer in the ALA feed using week 3 as a tag. Thank you for listening. I'll speak to you soon.